Hey everybody. Okay, so thank you for becoming a member of the Roar Signal Service Room, and I'm going to teach you right now how to use what you see on the chart right now, which are these levels that you're seeing here. And I'm going to explain them to you to help you give it a little bit more confidence in them and teach you how to use them. Okay, so what are these levels? Why are they here? And why are they important? All right. So these levels are all based on statistical analysis of range and volatility. Okay. Now, when I say that, what I'm talking about is real volatility, not implied volatility. And so what I do is I do a daily, I take an average of a daily frequency distribution. Now, if you're not familiar with these things, a very common tool in the investment industry. And basically what it is you run the data off of, the open, high, low, close and the change, and you come up with some statistical numbers on how much or does an asset move. And in this case, this is the SPX or the S&P 500, SPX 500. And every 3 months, I run this data. Sometimes I do it a little bit more, and I come up with a bell curve basically. And what I want to see in this bell curve, and what these numbers are reflecting, is we're seeing how many times in the sample size did the SPX do XYZ. And you can see on the bottom scale here, we have a greater for between a 1 to negative 1 to negative 1%, negative 0.5 to negative 1.5, negative 0.25 to negative 0.5, 0 to negative 0.25, then we have 0 to plus 2.5, 2.5 to plus 1 plus 0.5, 0.5 to plus 1, and 1 to plus 0.5, and etc. Okay, so what we have here is a frequency distribution, right? Now, what I'm particularly interested in when I'm looking at these is how often is it respecting the ranges. Now, this is just raw statistical data. In the levels that we have here, we massage these levels a little bit more to be more robust, if you will. So more on a day-to-day change, we adapt these levels to fit into these statistical models. But at the end of the day, it's basically the same thing, right? It's just a little bit more accurate when we use these levels that we're plotting here, okay? Now remember, these are from open to close. So if we look at this data, what we're seeing is the vast majority of time over a 12-month period and a 3-month period, the SPY is not going higher than 0.15%, right? And is not going lower, not going lower than negative 0.15%, and not going higher than 0.1 or 1%, right? The vast majority of time, it's safe to say that probably 88% of the time we're staying within this range. Pretty cool, right? And usually, this is actually a really interesting outlier year so far this year. Usually, we don't even have this fat tail over here. Like typically, the range will look a lot different. It usually looks like a pretty smooth bell curve. Right now, we're getting a little bit of a fat tail here and a little bit of a fat tail here, which is interesting. You might want to take note of that. But it's all adapted into our levels as well, anyways. But what it basically means is that for the vast majority of time, the market will open and range between these levels here. the vast majority of time. Okay, these +1, +2 levels. Okay, this is an adapted +2 level. It's not 0.5%. It's adapted to the current volatility a little bit more accurately than the last 3 months or a year. Okay, so for the vast majority of time, probably 88% of the time, you can expect this asset to range within these ranges. Okay, now will it bounce back and forth perfectly? No, there's going to be biases towards that. Some days we're going to have long biases, some days we're going to have short biases, and you can see those will be posted in the room every morning. For example, the SPX had a long bias, Apple had a long bias, Apple had a long bias. This was the day before. So if we take a look at those numbers, okay, you can see that the SPX, we opened here. It never did get down to this bottom range, but when it did get down to this bottom range, it bounced off a bit decently, right? Got a nice little trade there. Didn't quite make it all the way up to the top range, but it was a very random day. Okay, Apple, you can see here, Apple was a long bias. It went down to this level, almost touched this level. Okay, now one little note here, if you're watching this video, whenever you have a really, really big move the day before, these levels get a little bit messed up because they're not that adaptive. So just be very wary if there's a very big move the day before, like in the case of Apple, went way beyond its level. Okay, the levels won't be as accurate. They take a couple of days to adapt if there's a really big move, right? But you don't have to wait 3 months. But you can see here, Apple was bull bias. You could have bought that first level and bounced, okay? Amazon, again, here's the open, came down to this level and up she went, bullish bias. Google, okay, never went down to any level, right? Now, if I was really, really bullish on Google for some reason, I could use these levels as well too, like buying here to this level, okay? Meta, we'll look at that. Never went down to that level. Microsoft, yes, beautiful trade on Microsoft. You can see here, came down. You could have bought this level, you could have bought this level, and it bounced 2 levels. We were very bullish on that, right? NVIDIA was neutral. Now, I don't know what the heck went on with NVIDIA, but NVIDIA just made a wild move. Typically in a neutral trade, I will try to short here and try to short here. I would have been stopped out with my target up there, with my stop up there. Tesla, you can see we never went down to any levels. It just took off from the opening level. Now let's talk about how to actually use these levels. I don't like to use these levels as support and resistance, but they can be support and resistance. Okay, so I don't want you to fall into this trap to think, okay, this is support and resistance. No, remember what these levels are actually telling us. These levels are telling us that statistically we should stay between ranges. And so what is a big move, what is a small move, and what's an average move is what we're really looking at, right? So when I'm looking at these levels, what I'm looking at is saying, okay, if I am, let's use Apple as an example, so if I am expecting Apple to stay within this 0.5 and top 0.5 range, right? So if I'm bullish on Apple, if we get down to this first level, I'm excited, right? Because this is a level and you might want to look for other ways to enter your trades, right? Sometimes I just enter, but usually I'll wait for some type of confirmation, or you can use a footprint chart or whatever. That's your own personal thing. Maybe a doji candle, maybe an engulfing candle, right? When I see some type of support at this level, what this is telling me, these levels are telling me is, hey, a safe place to put my stop, okay? So if I'm long, if I'm buying this level, a safe place to put my stop would be below that second level below here. Right? That'd be a safe place to put my stop. Now, if I want to play it really safe, I could put my stop just slightly below this level here, because that would be a large outlier move. So this is the real secret to how to use these levels, okay? You want to be able to put your stop and your targets in the right place to make sure, because if you know a big move for Apple is way up here, right? That's an average move. A really big move for Apple would be way up there, statistically speaking, right? That would be a huge move for Apple, statistically speaking, right? So maybe I'm really bullish on Apple for whatever reason, right? If I'm really bullish on something, I will let you know. If I'm really bearish on something, I will let you know in the room, okay? I would put my level up there, okay? But for the most part, if I am bullish on Apple, which I was, I will buy this level, and I will buy this level, okay? And I will scale into that trade, okay? Now, if I happen to scale into that trade, depending on the context of the day, right? If all of these are green, I'm going to be pretty aggressive in my buying, right? If these are all red, I'm going to be pretty aggressive in my selling. And again, I'll post these every morning. If these are all neutral, I'm going to be very passive in my buying and my selling, right? If one of these is red and they're all green, I'm going to be very waiting for like the third level if I'm going to thinking about shorting that one, right? So NVIDIA, I didn't short this one until the second level because the rest were so green, right? But if I'm planning on scaling into my trades, and this is something that you have to understand, with this strategy, it's not an all-in, all-out strategy. It's a scaling strategy, right? So if I was bullish on Apple, I would have bought here with my stop down here, right? And if it would have got down to this level, I would have considered adding to the trade. And then my target would have been adjusted. So if I would have added for this trade right here, looking for a target right here, when I get to this level down here, my size would be probably double, right? So let's say I'm assuming I do not want to lose more than, you know, $2,000, $1,000 on this trade, right? Max loss is $1,000, okay? Okay, so if I want to lose $1,000, there's two ways I could break that up. And again, this is all up to your personality. I'm not going to tell you what I do because I'm a very different person than you are. The point is you have to know what these levels are doing and how they work, and then you decide what's best for you. Some people might decide, okay, on that first trade, I'm only going to risk, let's say $250 on that first trade, okay? Okay. So you can see if you had adjusted that to $250 risk, you would have bought 130 shares of Apple at that level. But you may have been planning on your second trade to risk $500, okay? So now you're down here. When you get to this next level, you would have bought 130 shares here. You would be buying 450 shares here, okay? So now you had $750 risk. Now some people might even say, you know what? I don't even like that too much. I want to risk $1,000 maximum, okay? And I want to scale into this trade. So on the first trade, I'm going to put my stop way down here, my stop down here. Now here, I might risk $500 a trade, $500 at that point. Here, I might risk $250. Okay? So the way we got this set up is that if this trade, you're buying 88 shares, you're going to lose $250 on that trade. This trade, you're buying $132 a share. If it stops you out, you're going to lose $250 on that trade. And this trade, you're buying 515 shares. If it stops you out, you're going to be losing a total of $1,000. But look at how cool this strategy works. Now, let's say that you get long here, the market comes down even lower. So you're long here, market comes down to here, right? You add to your trade, but the market comes all the way back down to here. Now you add extra large size. Well, guess what your average price is going to be? Your average price is going to be someplace around here. Okay? That's what your average price is going to be. It's actually going to be lower. It's probably going to be around 169.61. So you're break even at this point in time. So if the market does go to levels, right? Now you do a lot more than break even. Now you actually are going to make quite a bit of money. Okay? Now I'm not going to tell you what you should do. I'm going to share these levels with you, and I'm going to share the biases on the day with you. I will also in the room share with you what I am doing in terms of what levels I'm entering, and if I'm going to be taking small, medium, or large size. Okay? It would just take too long for me to tell you exactly how much to buy or sell. But I will say I like this trade for small size. I like this trade for medium size. I like this trade for large size. But a simple way to think about it is if that all the big seven and the SPY are bullish bias on that day, I'm probably not going to be scaling in three ways, right? I'm probably going to be taking bigger size here and bigger size here. I don't need this particular trade because so many are bullish. So pay attention to the distribution of the pre-morning bias is what I'm trying to say. Okay? And then plan your trade out accordingly. All right, so that's how you use these statistical range volatility levels. If you want a better way to do it, right, you could also use candlesticks, or you could use rejection. So for example, let's say that I had these statistical ranges long bias Apple, and what I saw on Apple was this little doji right there, okay? Or you can use footprint charts, or you can use any type of reversal candle that you want, right? If I'm bullish, okay, you don't necessarily have to use the levels as entries. You can find other ways to get into the levels, but use the levels as targets and stops. That's the biggest use of these levels. I cannot stress that enough. Okay, so that's how you use the levels, and that's how you use the biases. I will also be sharing other types of trades in the room that go beyond the statistical range volatility levels. But please make sure you watch this video in its entirety. It's very, very, very important you watch it. This is the third video I've made on this, so if you watch the previous two videos, please ignore those other two videos and use this video as your Bible. Okay, thank you guys, and bye for now.